Okay, so we're going to start in just 1 minute. Okay, so thank you all for logging into our international conference titled Model Portfolio Asset Allocation. Today with us, we have MBA Jan R. Herburt-Hewell. He is an investment management specialist at a large US financial institution. He has won confidence of numerous private wealth clients, endowments, and foundations by successfully managing more than 35 million US dollars in assets in a discretionary capacity. Jan routinely partners with trust officers, wealth planners, financial advisors, and private bankers to create innovative and full balance sheet solutions and estate planning recommendations for individuals and institutions. He is also a former Marine where he received the Afghanistan campaign medals for deployments in support of Operation Enduring Freedom. Thank you, Jan.
Well, Alberto, thank you very much for the kind introduction. Miguel, thank you. I'd also like to extend my invitation to everyone at the Mexican Institute of Financial Executives for giving me the opportunity to speak today. For everyone who's in attendance, who took the time to come out here, I hope that you're safe and healthy and happy in this kind of unprecedented moment in history, and that you're all doing our part to collectively survive this pandemic. So as Alberto said, my name is Jan. I've been in private wealth management now for 3 years, kind of have a non-traditional background. I started off getting my bachelor's degree in mathematics, and then after I graduated college, I actually served 8 years in the military where I did nothing with finance. And then when I got out, I went back to school. I got my MBA with a concentration in finance, and that's how I wound up in this industry. And I'm also a level 3 candidate for the Chartered Financial Analyst designation. The caveat that this conversation is going to really be in generalities from what we say is a bird's eye view or a 30,000-foot level. And that's for a couple reasons. One, a lot of these topics go really in depth and there's just no time to discuss it in an hour. And the other reason is, all these financial firms and investment specialists and professional money managers, we all follow the same basic principles and foundations, but the specifics and the details, that differs between each firm. And a lot of it's proprietary. If they have an interesting or effective way to value a company or a stock, or they think they have some technique that gives them an advantage, they don't share it with you unless you're a client. So it's kind of hard to get into the details because that's everyone's special ingredient, and they don't like sharing it. So we'll just keep it kind of general, just so you get some ideas of how to learn more about asset allocation. So let's start with the origins, modern portfolio theory. The father of modern portfolio theory, Dr. Markowitz, in the 1950s published a paper where he mathematically and quantified, kind of proved, I think, what a lot of investors already knew by then, And that is, if you're going to invest money, don't put all your eggs in one basket, right? It is advantageous to spread your risk out and get into multiple investments. So if you see the graph, I'm sure several of you have seen this before if you studied finance, this efficient frontier that he's created. And he basically says that there is an ideal portfolio. For every level of risk, there's a maximum level of return that you should achieve. You can optimize this process. And a lot of this has to do with the correlation or covariance between assets. And that's just a statistical term that means, what is the relationship between assets? Are they highly correlated so that they move in tandem? They both go up and down at the same time. Or they have low correlation and one goes up and one goes down. And that's kind of like the desired end state because that reduces the portfolio variance. Part of his theory also said that stocks are really subject to two kinds of risks, right? The first one is systematic risk. This is market risk. These are things like recessions and interest rates, and this impacts, all stocks. There's nothing you can do to avoid it. The other form of risk that stocks are exposed to is unsystematic risk, sometimes called idiosyncratic risk. This is specific to the firm or the company. This is based on management decisions, sales practices, and what he advocates is through diversification, you can eliminate unsystematic risk. You can reduce this and get better returns on your portfolio. So, I don't want to turn this into too much of a math conversation or try to really prove his theory because it gets very technical very quickly. But I think maybe a simple example helps put things into context. So the most simple example you can think of is a portfolio of two assets, right? Stock A, stock B, equally weighted, 50% in A, 50% in B. So if you want to know the expected return for that portfolio, it's really quite simple. It's the average of the two returns. So if you have a 5% return in one stock and a 10% return in the other, you would say that the expected return of that portfolio is going to be 7.5%, just the average. But when it comes to the variance or the standard deviation, and I apologize because I do use these words interchangeably, not to confuse anyone. Most of us know that the standard deviation mathematically is different from the variance. It's the square root. But conceptually, they really mean the same thing. They're almost interchangeable. It's just the deviation from the average, the dispersion in your returns. The more dispersed, the more variance that you have. So, for example, if you have a average return of 7% and it's because one portfolio gives you 6% returns and the other one gives you 8% returns, that's a very different variance than a portfolio that gives you a 7% return because one asset gives you 2%, the other one gives you 12%. So the distance that these returns have is impactful. All right. So if you look at this equation, it's pretty nasty. I'm sure some of you have solved this at one point in your financial studies. If not, I'm sure you will. And I hope professors are nice and only do the two asset case. It gets very ugly. But this latter term, the third part of this is where the relationship between the assets come into effect and you get the benefits from their covariance with each other. So he shows that, when it comes to portfolio variance, it isn't so much the individual asset variance that matters, the individual risk that matters. It's the covariance, their contribution to the portfolio and how they interact with each other. So, using that, it's how we kind of came up with this efficient frontier and he built this nice little chart we have on the right. So, you're looking at the chart and you can see that it's a continuum, right? There's lots and lots of portfolios that fit on an efficient frontier. So, the question is, okay, great. Like which one do I pick? Well, it all depends on whichever one brings you the most happiness or personal satisfaction. And in economic terms, we consider this utility, right? The higher your utility function, the happier you are. And there's the utility equation there. It's a function of the expected returns of the portfolio. You have this variable A, which is really a variable that reflects investor risk tolerance. And then you have the variance of the portfolio. And if you were to plug in portfolios and graph them, you would start to generate what are called indifference curves. And as you plot more and more indifference curves, they eventually intersect with the efficient frontier. And that's ideally where the investor would want to put their money. That gives them the greatest sense of happiness. And then you still, we're all constrained by how much money we have. So you have to have a capital allocation line, like how much money are you going to put? There's always risk-free investments, and then you can put it all into this optimal portfolio. And once again, where the capital allocation line intersects the efficient frontier is where the individual investor is the happiest, and the capital market line is just a special case of the capital allocation line. Anyway, so that's a kind of simple overview of his very detailed work. And the big takeaway of this is that he showed that there are benefits in diversification, primarily the reduction in the variance of portfolios. And you could create an optimal portfolio. And for the last 70 years, we have been using this as a foundation for how we invest money. So it shows how powerful it was to quantify these findings. And it is the basis for asset allocation. So let's look at some of the principles involved in asset allocation. I'd like to start with this simple example, and it kind of makes the case of why we're interested in reducing volatility, right? What is the big gain here for an investor? Why is this important? So you come up with a simple example, 3 different portfolios. They all start at about $1 million. And you can see that they all have the total, arithmetic return at the end, it's 30%, but their path there is very different, right? And you can see portfolio A, the portfolio that achieved the most consistent returns, that had the lowest volatility or variance, ended with the highest returns, even though in any given 1 year, it wasn't the best performing portfolio. And we know that. We know that well-diversified portfolios are not going to give you the very high returns, but hopefully they give you consistent returns, which in the long run is to your advantage. This is kind of an ugly chart, but it's one that every large financial institution always makes. It's called a Quilt Chart, right? And it just shows all the various asset classes that investors can invest in over the last several years and their changes throughout time in terms of performance and risk. And what you take away from this is that any one asset class can go from the number 1 performing asset class 1 year to the bottom one. There's a lot of variation, and we just don't know. It goes back to Matthew McConaughey saying, nobody knows what's going to happen in the stock next year. So the best idea is maybe get a diversified portfolio, combine several of these assets in an efficient manner, and reduce the overall volatility. And then that's going to give you, more optimal returns, or, at least returns that you're happier with. And I know some people will look at this and say, doesn't make any sense to me. If small cap has been winning the last 10, 20 years, I'm just going to put all my money in small cap. And that's fine. It all depends on the investor. If you have the time horizon to endure the volatility, if you're starting to invest when you're 20, 25, 30, a well-diversified portfolio isn't necessarily that important to you because you have the ability to withstand the variation and then just hold on to your funds. But not all investors have that time horizon. It's very different when you're already retired or it's funding some sort of certain goal. So, it really depends on a lot of it on your time horizon. And then there's another consideration, right? Financial advisors, professional money managers, this is a service, right? We are providing this to clients to help reach financial goals, and we want it to be enjoyable, or at least enjoyable as possible. And most investors suffer from a bias called loss aversion, right? This is the idea that if you, win $10, that happiness that you get from winning isn't as great as the pain you get from losing $10. And you see examples of this all the time in real life. If you're getting into a bet with someone, it's the loser who's going to say double or nothing because they want to get made whole. They don't like the feeling of losing. And the winners care a little bit less. They're not as incentivized to continue to risk, right? So, when you have these giant variations, that makes the investing experience less pleasurable, if you will, for your clients. And I promise you, they are going to remember the year that they lost 30%. They're not going to remember the year that they lost 20 because of this loss aversion bias that almost everyone suffers from. So it's another, reason why we really stress, the benefits of a diversified portfolio. And like I said, the example says that reducing variability, that simple example shows that reducing the variability ends to more consistent returns, higher in the long run. And if you look at the asset allocation, most of it comes, most of your portfolio variation comes from your asset allocation. It's the largest contributor. It's not so much the stocks you pick. Everyone is going to kind of diversify the stocks. Nobody's going to over-concentrate in professional money management. So your security selection, surprisingly, is not that important. It's actually the framework of the portfolio, how you allocate these various assets. I should also note that there's several different allocation strategies. There's asset only, which is what I'm discussing because that's the optimal way to do things. That's a rational investor, and they want to get the optimal portfolio with the most efficient returns. But there's also, liability relative allocation, right? So if you're a pension fund or an insurance company, you're not really worried about getting, risk-adjusted returns, right? You need to offset a liability, right? You got to pay the claims, you got to pay the pension. So your portfolio allocation looks very different when your sole purpose is to make sure you have the funds to offset a specific liability. And the final one is like a goals-based allocation. This is, starts to go into the realm of behavioral finance. It's very common, right? A lot of investors and clients, they like to allocate risk specific to a goal. So, how they invest money for their kids' college fund might be different for how they invest money for their retirement fund, especially if they're retired, or maybe they want to put money to help fund building a new house or renovating. So they have these different goals and they kind of compartmentalize the risk for each goal, and then you end up building a portfolio suitable for that goal. In aggregate, you end up with portfolios that are less efficient than the asset only if you just had one portfolio and you try to optimize that. But the reality in the industry is we tend to go with goals-based investing quite frequently. So it goes back to this is a service that we provide people, and we want to make sure that they're happy with it, that they're comfortable with their investment choices, and this is a great way to kind of meet those needs. Okay, so let's look at how do we build this asset allocation. First, we got to get a universe of asset classes, and there's quite a bit. And asset classes are just investments that share characteristics, right? And they're mutually exclusive. You're not really in an asset class if you're another one. You're either large cap or mid cap. You can't be both. So you have to share similar characteristics, and it's mutually exclusive. The first two columns, I think everyone's very familiar with. Equities or stocks and bonds, equities and fixed income. Yeah, there's various forms in each one, different market caps. You can have foreign, domestic, and fixed income. You have also different levels of credit riskiness from investment grade to high yield, also foreign, domestic, etc. And then the last two columns are often grouped together. They're considered complementary strategies. It's a term for them often used. I split them up into real assets and alternatives. I think it's a little bit easier to conceptually view them. But as we learned more about investing and the evolution of modern portfolio theory continued to take place, we realized it's very desirable to find assets that are not correlated with traditional stocks and bonds, right? If you can find something that is like a hedge almost, an inverse relationship with your stocks, and that's great. That really dampens the overall volatility of the portfolio. So what you see is more and more asset classes coming out and more investors getting interested in these asset classes as they provide diversification benefits. The alternative section, the HF there stands for hedge funds. These are the big hedge fund strategies that are available. You have to be qualified investors, at least in the United States. Not anyone who gets into investing can invest in a hedge fund. You have certain minimums because they want to make sure sometimes there is more risk associated with it. There's definitely more sophistication. So they try not to let just anyone who get into it who doesn't have the means or the ability to kind of endure the additional risk with some of these sophisticated. So we have all these asset classes. And the next step, and this is like, where the sausage is made, as we say. This is the big part. We've got to create capital market assumptions, right? we have to do some forecasting, right? We have to look into the future. If we only cared about the past, we would be accountants. We wouldn't be in finance, right? So we have to think long-term, mostly because in the short term, you see erratic behavior. The efficient frontier doesn't always behave like the efficient frontier. So you really need to get out into at least a business cycle or two, so 10 to 15 years, for the risk and return characteristics to behave in a way that is in line with the efficient frontier hypothesis, right? So it's going to long-term view is what you do when you forecast. Now, when you forecast, you're going to have to use some of historic performance. You can't ignore it. I mean, history doesn't repeat itself, but it does rhyme. You can't just ignore what's happened in the past. So you're going to look at, historical returns, historical standard deviations, historical correlations, and you're going to, incorporate that into your model for forecasting, right? Probably look at averages, something that stays within the maximum and the minimums. And then you're also going to have to do some predicting, right? You have to get involved in econometrics, which is just, statistical models that are used to explain variables. But you're going to want to try to get a forecast for, at the very least GDP, right? Because it's correlated to how assets perform. So you want to say, okay, this is what I think, this country is going to perform over the next 10, 15 years, GDP growth-wise. And there are lots of different ways to do this. There's very simple techniques. Often GDP just really comes down to a product of, the labor growth rate and the productivity growth rate of a country, both long-term, but they're far more sophisticated models, can do some searching. So, and then once you have, your predicted data and your historic data, now it's time to decide, how do I weight these? And every firm has a different opinion. You could do 50-50. I'll do 50% historic or 50% predicted. Or you can say, no, I have a strong conviction in my predictions. I'm going to go ahead and weight this 70% on my predicted analysis and 30% on the historic. Okay, so you have to do once you get your forecast, you can start, building out these forecasts. And there's lots of different ways. You can do a top-down approach, bottom-up approach. I like the building block approach. It's used by a lot of firms. I think it's because it's portable, because once you do the research on something like expected inflation, you can carry that out through almost every asset class, because every asset class is subject to inflation expectations. So you don't have to redo work or start from scratch. You kind of build your way to the top. So this little chart that I have there is kind of like a visual, display to conceptualize how the building block, it's not drawn to scale and it's missing all these asset classes, but just give an idea. So once you have these kind of foundational principles, which is normally inflation and, a cash premium, you got to figure out your risk premiums. These are returns above the risk-free rate, right? These are what investors are looking for. The risk-free rate is really just a proxy for treasury bills or whatever central government that you use, or their short-term investments and debt offerings. And you have to look at it, you have to figure out your own equity risk premiums, right? And once again, there are for you to calculate an equity risk premium. It can be a single factor model, like the capital asset pricing model, the CAPM. I'm sure a lot of you are familiar with that too. It just says, a stock's performance is really kind of, related to its market exposure, its beta. You can get more complex with multiple factor models, the FAMA 3-factor, FAMA French model, the 5-factor FAMA French model. And they said, hey, look, there's more to what's driving these, risk premiums than just the market. There's considerations for, market cap, small cap, value, et cetera. And in this day and age, everyone who's professionally managing money is going to have, for the most part, international exposure in a well-diversified portfolio, right? If that's what you're building for a client, you're going to suffer if you don't have some exposure to companies in China and Southeast Asia, markets in South America. There are opportunities there, and you can't ignore it. But that means you also have to do other steps of due diligence. You have to figure out the country risk premium, which is also very complex. You have to, analyze their sovereign debt. You have to analyze their political stability. And there's, tons of different formulas and things you can Google if you're interested in that stuff to see how people kind of decide what is an acceptable return if I'm going to invest in Colombia, right? Like why do I expect that return? And the same goes obviously with fixed income, right? They are also considered risky assets. They're credit assets. There are different premiums there that you have to consider. There's a time horizon. There's your duration risk. There's a default risk. You don't always get your money back just because you buy a bond. Depending on the kind of bond you buy and the issuer of that bond, you have to take into consideration that it might not give you back the loan that you gave them. And there's credit risk as well. Maybe it doesn't default, but it could go down from AAA to AA or from BBB to BB. And that's going to highly affect the value of that bond in the secondary market. Now it's not what people thought it was, and they're not going to pay as much for it if you try to sell it because that wasn't the original expectations. So you take all this data, all your forecasts, and what you do with this is you put it into a software. It's called Mean-Variance Optimization. Lots of different people provide this software. Mean is a proxy for return, variance is a proxy for risk. So optimization just means the software is trying to find you the most return for your risk. It's going to take in your hypothetical risk, return, and correlation and spit something out. And you'll also have to put in certain constraints into your software. In other words, it won't really give you a diversified portfolio. So you'll have to limit certain asset classes based on real life knowledge of how these asset classes perform, because the computer will give out something that's not really feasible. So I'd say this is a huge portion of your asset allocation. It is getting the assumptions for your various asset classes and then using software to figure out which ones you should invest in, what gives you this optimal risk and return. And you can actually do this on Excel too. I mean, if you're savvy with Excel and you know how to use Solver, you can do mean variance optimization. But most firms will use software specifically designed for it. And then when you get this output, maybe this comes from BlackRock, I believe. These are their capital market assumptions from some time ago. And you can see on the left, I apologize, it's kind of small, all the different asset classes that they like to invest in. The bars obviously represent, all the various plausible returns with the average denoted by some circle in the middle. And those averages are going to be the mean that they put in, and the variance is going to be the dispersion of these returns. Okay, so that's just a visual example of the results of your mean variance optimization. But that's still not very helpful. So, the true final result is really this table. Right? Once again, it's kind of small, but on the left-hand side, you see all the different asset classes that you can invest in. And then imagine that each of these columns, right, represents a different portfolio on the efficient frontier. The leftmost is the least risky portfolio, and the rightmost is the most risky, optimal portfolio on a firm's efficient frontier. And you can see that kind of intuitively if you look at the various asset allocations. You can see that at the end, at the far right, you have 6% to bonds and 87% to stocks. We know stocks are riskier than bonds, so it makes sense that the computer would, if you tell it to be aggressive in its mean variance optimization, that's a constraint that it favors stocks over bonds. The natural question is, okay, great. So I have this chart. I've done all this hard work. I got my capital market assumptions. I did a lot of research and due diligence on, figuring out my hypothetical risk returns and correlations. And now I got my mean variance software and I put it in. I have all these different asset allocations. How do I use it? Like what do I put in for, 25% large cap equities if I'm all the way to the right, 19% mid cap, 17% small? What do I actually fill that with? And unfortunately, there's no one answer. I would love to say you always do this, but you don't, because it's going to depend heavily on the needs of the client. And so we have clients who are income oriented. They like dividends, and that's how they maintain their standard of living. So the stocks I put in there are going to be dividend related stocks for those different asset classes, or high dividend paying bonds. And then we have other investors who are very aggressive. They don't care about income. They want to see appreciation and growth. And then if you look at your large cap space, you're going to fill it mostly with stocks that resemble the NASDAQ or growth stocks. So there is no one answer, right? All of this point has been science. It's been, formulating assumptions and using software to create allocations. But now you have to get into the art. You have to understand the needs of your client or of your investor, and you have to pick the actual products that are best suited based on what they really need from the portfolio. Okay, so we built the portfolio. We're very happy. We have all the assets in it when it meets with the investors' returns, but now we have to actively manage it, right? The first step is done, but that's just the beginning of the portfolio management process. So now we got to get into, can we exploit opportunities, and how do we maintain the portfolio that we've created? So we'll start with rebalancing, right? So all portfolios naturally drift. Like once you have your portfolio and you actually start investing, because of market movements, it's natural that certain asset classes get wider while others get smaller. Like large cap is going to grow, bonds will probably shrink. What end up happening is your portfolio's allocation will look different than what the optimal portfolio you created and you had on your efficient frontier. You have steered away from the risk profile of your client. So you have to rebalance it because that was the agreed upon portfolio to begin. The other nice thing about rebalancing is, one of the basic fundamentals of investing is buy low, sell high. Right? So that's easier said than done quite often, right? It's easy to say I'm going to buy low, sell high, but fortunately rebalancing forces it, right? Because if you think about the asset class that has grown, it has appreciated, right? So if you have to trim it, shrink it down, you're selling that higher asset, and then you can put the money in the one who shrunk, who's now cheaper, and you can invest there. So it's a great way to kind of do the foundations of investing. So how are the techniques for rebalancing? And there's really just two, right? You could do a calendar approach or a corridor approach. And calendar approaches are simple. It's just every quarter the portfolio gets balanced, regardless of what's happening. You see this a lot in robo-advisors and things, non-sophisticated tools and techniques that just rebalance it. Your 401k probably uses a calendar approach. The corridor approach, all right, is really what active managers are going to do and discuss with their clients, right? So let's say 30% is what you consider an appropriate allocation to equities. You have to decide, well, what's my window? Can it be from 25 all the way to 35? Can it be 20 to 40? Can I stay within that range before I rebalance? Or can I only go down from 28% to 32%? And then I got to change the portfolio I've created and rebalance it. And that's a conversation you're going to have with the client and kind of figure out. There are considerations you have to take, right? There are transaction costs. Every time you buy or sell a stock, it costs money. Brokers are paid in this process. There are taxes, right? When you sell an asset that is appreciated, there are capital gains. And this is a taxable account, and you set your corridor to plus or minus 1%, you're going to be constantly rebalancing, and come next April when they get their tax bill, they're not going to be very happy with how you manage their portfolio. There's also momentum. Maybe you want to let it drift because you think it will continue to go in that direction, and you're going to get higher returns for your client. So you're going to have that discussion. Finally, you don't actually have to sell or buy anything to rebalance your portfolio. You can change exposure with derivatives. I mean, futures is a great market to change your portfolio beta to give you more or less risk. If the client is sophisticated and comfortable and capable of it, then you could kind of bypass the whole tax issue and go ahead and buy the right kind of futures to hedge your portfolio. And then there's also liquidity considerations. If you are working with high net worth individuals and you have private equity, private debt, or hedge fund or real estate investments, you can't just sell today or tomorrow. It doesn't work. They're not that liquid. And they get higher returns because there is a liquidity premium, and their strategy requires that they hold on to money for a while. So, not every part of your portfolio can be rebalanced just like that. It doesn't work. Tax loss harvesting, that's not really what I would consider part of your rebalancing strategy. Everyone does it, especially in the US. According to our tax codes, if I have an asset that has a loss and I sell it, I can offset gains for another asset that appreciated. So, you look at your portfolio as you're coming towards the end of the year and you start buying and selling things to help reduce your taxes that they'll incur. And that's not really part of rebalancing. It's a different strategy. And very often you sell something and replace it with very similar. SMAs, separately managed accounts, sub-accounts, sleeves, whatever you want to call it. In this day and age, finance and investing has gotten extremely complex. There's a lot to know. And very often certain segments of the portfolio are kind of given off to, subject matter experts in that field because you believe that they will get a better return than you will. And just realize that they're going to be doing their own rebalancing, their own tax loss harvesting. They got to follow their strategy mandates, which is probably not a diversified portfolio. It's a large cap growth strategy, or it's a high yield bond strategy. So they have to make sure that they're adhering to it. So be cognizant of that. There will be churn in your portfolio as you use these people. So it's going to affect total allocations and rebalancing as well. Okay, now the tactical shifts, right? And this is where we exploit opportunities, and every firm does this. Every firm, large firm, is going to give guidance to their investors and portfolio managers on what assets they should underweight or overweight relative to the original asset allocation, right? We know that the long-term assumptions that we use to create the asset allocation strategy, this optimal portfolio, are necessary in that building block. You need long-term assumptions. But in the short term, they don't hold up very well. Things is a very dynamic and fluid environment. Things change all the time, and you want to exploit those to increase your returns or reduce the risk for your clients. So this happens very frequently where guidance is given. It can be on, portfolio factors. Factors are long-time drivers of earnings, like growth or value. There could be different times when you want to tilt the portfolio one way or another. Very often this has to do with the business cycle, right? You always have to be aware of where you are in the naturally occurring business cycle, because if you're just coming out of a recession and you're in a high growth environment or starting to build back up, it's very different than if you're about to enter a recession or you're at the tail end of the business cycle when interest rates are high, inflation's high, and growth is slowing down. You also have to be cognizant that if you have a diversified global portfolio, like most of us do, that there's exogenous shocks to certain countries and regions, right? And, a great example of that is, feels like a long time ago, but when England was talking about exiting the European Union, Brexit caused a lot of turmoil in the Eurozone and financial assets that were there. There was also a lot of negative yielding debt in Europe. And, you had issues with the solvency and the sovereign bonds of places like Italy and Greece. And it didn't make sense to overexpose your clients to that region. You would trim your portfolio down. That would be your tactical shift, would be to underweight it by several percent. Same thing goes with industries and sectors. There's 11 sectors in the S&P 500. They're cyclical and defensive. And, they all don't perform the same throughout the business cycle. It depends on where you are. Utilities and consumer staples are great during the recession because nobody's going to, turn off their electricity just because, there's a recession going on. There's a constant demand for it. Those stocks do well. But, if you come out of it doing better, these are not the industries where you want to overweight your portfolio. You're going to really lose out on returns. You want to go to the cyclicals, the consumer discretionary, when people start spending money, information technology. Same thing, you have commodities in your portfolio. Commodities don't make any money. There's no earnings associated with it. It's all supply and demand driven. And when these, supply and demand relationships change, let's say most recently like oil, where there's a collapse of demand and an increase in supply, and the prices bottom out, as you realize that environment's coming, you want to reduce your exposure to those commodities. Or, now that the situation has changed and you see that there's a lot more demand and not enough supply, now it's time to increase it. So every firm has got their own, reasons and justifications for these shifts. That their due diligence, their analysts are working hard at this. And then, the portfolio managers are going to implement it in a way that coincides with the investors' risk tolerances and desired outcomes and what makes sense for them. So I think an example is always helpful. I think the one that everyone's most, front of mind is, kind of the current environment, this pandemic that we find ourselves in. So let's go back maybe a few weeks. The market's just crashing. You got to do some changes to your portfolio, right? Your clients will be livid otherwise. It's the prudent thing to do. Or maybe you're going to invest money. Somebody had cash on the sidelines and is lucky to get in as the market crashes. So considerations, right? The economy is stopping, right? You're looking at equities. Do you want to invest in large cap or small cap? Well, these large cap companies, they have cash on the sidelines. They can weather the storm. They have access to capital markets. Banks will lend to them. Private investors will lend to them. They can weather the storm. Even when every business is closed, Amazon is not. You can still shop online. It would make sense to continue to have exposure to them. Small cap, maybe not as much, right? They don't have the ability to weather the storm. The same thing can go with your bonds, right? If you were a high yield investor and you have bonds that are paying a premium because they are considered risky, they're junk bonds. Now, these companies that weren't doing very well financially and had to issue junk bonds, now they're not even open. They're collecting no revenue. How long can they continue to make these interest rate payments, right? They might likely default. It would make sense in the bond environment to be, a little worrisome of these high yield companies and go towards investment grade. As far as emerging markets versus domestic. Emerging markets, even developed markets outside the United States, they don't really have the resources to really help them through something like this kind of pandemic, not to the extent the United States has. We're spending trillions of dollars to sustain our economy, to make sure this economic crisis isn't a financial crisis. We're bailing out companies. We have a disproportionate advantage. In smaller emerging markets, they're struggling to have testing to cure this. They have to borrow a lot of money at rates that are really high because people don't trust their ability to repay it. It makes sense to shift the portfolio in that environment. And then, I would say a quality bias is what most people would advocate in this time. And what I mean by quality is as you're looking at your stocks and you're picking them, you want to look for the companies with low debt to equity, right? That they're not highly leveraged, that they don't have to worry about going bankrupt in this process. Their interest coverage rate ratio is high. They can afford their interest rate payments. You want to look at their return on equity. Is it consistent? Is it quality? You really want to focus on healthy companies that have cash, have high free cash flows that can, withstand the loss in revenue for quite some time. These are the sectors that tend to perform well, and then they make sense, right? Everybody's working from home. You can't not have information technology and communications companies. Every company is trying to figure out how to have their employees work from home effectively. There's more data demand. There's more products being released, more services. Healthcare, it's a race to find the cure or the vaccine or treatments. Consumer discretionary, especially, in the e-commerce department, right? We can't go to stores, but we still need things. We're going to order it online. So these are the sectors that, instinctively you would say that's where my money would go in this environment. Real estate investment trust. Also, this world is very much impacted of late because of this pandemic. It's bifurcated. There are certain REITs that are going to do well. The ones that are involved in data or warehouses that are involved in like distribution for Amazon, they're fine. But if the real estate investment trust was heavily invested in office spaces, some companies don't want to have offices anymore. They're reconsidering it. Or things that are closely related to the consumer and malls. I don't know. It's going to be hard to see. You have a lot of bankruptcies in companies like JCPenney and major malls like that, and department stores. And how are they going to afford their payments? So you have to be careful in this space and be very selective in this environment. I already talked about developed ex-US. Distressed debt. Yes, for most investors, there's good reason to stay away from high yield. But if you have a very long-term investment and you have the sophistication, there are specialists who only sell debt to companies who are struggling, right? Who have, yield spreads of 1,000 basis points, and they're, experts at, restructuring a company, and they can get phenomenal returns in this environment. This is the time you get into distressed debt. It maybe takes advantage of the companies a little bit, but for the investor themselves, you get tremendous returns in this space. Now, tax considerations. See, I've been talking for a while, but I'm going to keep this pretty light because it's very country specific. My example has to do with the U.S. It's where I'm most aware, but every different country has different tax codes. But in most of them, there's different tax structures for investment accounts, right? You can have deferred tax accounts or taxable accounts. In the U.S., we call them your IRA, your 401k. You have or a trust or regular investment account, and they treat taxation differently, right? So you have to understand the rules as you decide how to, invest them, how you manage that portfolio. And then you also understand that, the financial assets themselves have different tax treatment, right? Some are more tax efficient than others. Bonds, generally speaking, aren't very tax efficient, definitely not high yield. You have to pay ordinary income tax, which for a wealthy investor is quite high. And then you go all the way to the opposite end of the spectrum, where you get municipal bonds, which are, don't have any federal income tax. They're very tax efficient. And stocks have different taxing, capital gains, qualified dividends, normal dividends. Just realize there's a spectrum from least efficient to most efficient. And your job as a portfolio manager is to put the right assets into the right accounts. Because it doesn't make a whole lot of sense, and your client would be confused if they ever talk to anyone and you put municipal bonds in an IRA. What are you doing? Why am I not in higher returning asset classes? I don't need to worry about tax efficiency. So I know nothing about tax laws in Mexico, so I'm very sorry, but I assume there are similar principles as every country has similarities in the tax code. All right, manager selection. Very important as well, right up there with the asset allocation. Near and dear to every company's heart is how they select other managers that they hire to help them manage money. And there's a reason why we do it. And like I said earlier, investing is like being a doctor, right? Every doctor knows the basics, but you wouldn't go, if your heart hurt, you wouldn't go to an orthopedic surgeon. It doesn't make sense. You would go to a cardiologist because that's his specialty. And, there's so much information, there's so much money, there's so much smart people involved in this process that it's hard to be, if not impossible to be good at it. You're not a good stock picker and a good bond manager, and you don't know also how to do options effectively, because the people who do it every day are going to crush you in comparison. That's the world. So you specialize. So a lot of times you're going to have to outsource it. And I think having a manager selection process, whether you're a major institution, which is the viewpoint I'm speaking of, or just a personal investor, is important, right? You want to have something that's consistent and objective, so you can look at different people and screen them out and find the ones that you're most confident in, and he's going to have some sort of qualitative and quantitative approach, right? And you just want to make sure that you kind of stick to it, that you're disciplined. The best investors are the disciplined ones who are patient. They tend to have the best returns. So from an institutional standpoint, we're going to look at the firm, right? We're going to see the culture of the firm, their compliance procedures, what's the succession plan for their executives? Are they thought leaders in this space? Do we really have belief in them? We're obviously going to, on the qualitative side, look at the investment personnel and their experience, right? What is their training and background? And also, very importantly, how are they rewarded? If they're not paid very well, they might not stay there very long. And we want to have smart people stay with that company if we're using them as part of our allocation to emerging markets, right? So we want to understand these things. We want to understand their investment philosophy. Is it clear? Is it consistent? Is this skill or is this luck? How transparent are they? How do they do their research, right? Do they generate their own in-house? Do they use external research? If you're hiring or if you're putting a mutual fund to manage emerging markets in your portfolio, how often are these guys traveling to China and South Korea to visit the companies that they invest in? That you want boots on the ground to check the products. So you're going to take a look at all this stuff. Obviously, you have to look at the product performance, right? And there's so many different things, risk-adjusted returns, several different ratios there you can look at. You can look at rolling period returns, discrete returns. You can evaluate them according to their peer group, to their benchmark, what's their active risk, what's their tracking error, depending on the products they're involved in, what are some of the legal issues of the capacity. There's a lot of things that from an institutional perspective that we have to analyze. And just like portfolio management, it doesn't stop when you're done with your research, right? It's really an ongoing due diligence. So you have to figure out the frequency. How often am I going to check on these guys? Every quarter, am I going to look at their, fact sheet to make sure they haven't deviated from their strategy or there hasn't been any major changes? There's several risk optics you can consider. I put a box of some big ones. Have they gotten concentrated? Do they have liquidity issues? Are they taking out too much leverage or more than you're comfortable with for that strategy? So there's lots of things you have to consider as you manage the risk of having that person in your portfolio. And as important as your selection process is your removal process, right? You need to have disciplines for buying and selling things. It can't just be, on a whim, I'm going to fire them. That's, consistency is the name of the game here. So is it because they lost some of their smart people? Is it because their performance is really underperformed relative to their benchmark or their peer group? Has their investment process changed? Has their products changed? They have compliance issues now. Is the regulators coming after them? Have they done something inappropriate? There's some things you have to consider and just figure out, how am I going to decide when to hire and fire these guys? Here's an example of a scorecard. I think it's a great way to begin your quantitative process. You have a huge universe out there. I think there's something like 12,000 registered investment advisors in the SEC in the United States. I think there's more than 20,000 different products that you can purchase. So you got to start screening them, and it begins a lot with a mathematical screening. So you can build a scorecard, do some weighted averages. I don't know if it's performance or turnover. It doesn't really matter. It's a simple example, but just to get the idea of okay, how do I filter through this list to find 5 or 10, which I'm starting to feel confident in, that I can start to do the deeper dive, read the prospectus, read the qualitative information on the team, and figure out if they're a good fit to put into to invest money with them. And then, recent considerations, the plan, your manager selection should be consistent, but it should be somewhat flexible too. The environment changes. Now how we operate, there's other consideration. Everybody's working from home. At least they have been for quite some time. So what was the business continuity plan of the fund you invested in? Could they effectively work from home? Do they have all the resources there, the bandwidth available to support their strategy? What is their cybersecurity procedures? What's the economic viability of their firm and their strategy? If they were an investment grade, bond manager, but they had a lot of triple B, and a lot of those triple Bs got downgraded. Now they have junk bonds. What's their prospectus say? Do they have to sell them now? It's going to change the portfolio. So these are things we got to analyze. Liquidity risk. When the market's in a free fall, it's hard to sell things. You have to remember the market has a buyer and a seller. There has to be someone else. But if everyone is selling, it means nobody really wants to buy. So this creates liquidity issues. Sometimes you just can't find a buyer. You can't sell. And the same thing, goes with their health. If they're sick, what happens? And, if it's a dividend-oriented strategy, we know that a lot of dividends have been suspended. Companies don't know what to do. They're concerned about their income. So what are they doing in that particular strategy? How are they treating these dividend suspensions? Are they going to find new companies and turn over their portfolio, or are they just going to wait it out a little bit? So some new considerations that have all kind of developed during the pandemic. And then finally, let's look at some, other strategies. As I'm approaching the hour, I'll try to make this quick. Okay, modern portfolio theory, it's been around for 70 years, and it's still followed today. But like every economic theory, every strategy, every investment process, there are pros and cons. There are things that we accept that are not true, or for the sake of the economic analysis. So we know that, hey, look, this is based on projected values, right? We're guessing into the future. That's an imperfect science. We say garbage in, garbage out. If your prediction for large cap was that it's going to have a 40% return with a 2% standard deviation, you're going to have a really crappy model and a very poor, efficient frontier. We also know that a lot of the information is based on historical measurements of returns and volatility. And there could have been factors in the past that no longer exist today that impacted those portfolios. We're very cognizant of this. These are downsides. Smoothing is a big one, especially for real estate. Nobody's getting a property appraised every day, right? Nobody wants to know if their house is worth every day or a big office building, etc. So what you end up seeing is because these assets aren't frequently priced, they don't go up and down, you have inconsistent data, and it creates a very smooth standard deviation that's not really representative of the risk. So we know it's there. They're trying techniques to kind of overcome this, but you just have to be cognizant about it. Same thing, the beauty of modern portfolio theory is you find assets with low correlation. This reduces your volatility, but in times of a crash, correlations go to 1. Markets all, assets all kind of behave the same. And then, there's tremendous simplifying assumptions for this to work. We're looking at, for instance, volatility, standard deviation. We're saying that the standard deviation is 15%. That's right. That's the average, but we know it's a moving target, right? At the very least, there are periods of low standard deviation and periods of high standard deviation, high volatility. So for the computer to do its job, it makes it much easier to have these simplified assumptions, but that's not really representative of how the world works. And what it leads to is, disproportionate risk among some asset classes, right? So if you look at your portfolio and you say, oh, my money is in 30% stocks and 60% bonds or whatever, 10% commodities, and that's how your money's allocated. That's, that was the best risk-adjusted return from that asset allocation. But if you were to look at just the volatility of that portfolio, just the risk, that portfolio, 70% of the risk would come from stocks, right? And that's just the reality of it. And, the simplifying assumptions kind of hide that, but we know it exists. So some of the other strategies that are out there, and I won't get into too much depth, there's volatility targeting. You can have clients who I'm comfortable with this level of volatility, a standard deviation of 10%, whatever. And then you could build a portfolio with a combination of assets that target that investor's risk tolerance, right? You can get into risk parity funds, which just evenly distributes the risk of the portfolio. You see the little example there. It's, mean variance portfolio on the right, and then a risk parity portfolio on the left. You see that 20% of the risk is coming from each of those asset classes, where on the right, it's much higher and skewed to the equities. And that's great. That reduces the risk, but that reduces the returns as well. So a lot of times these risk parity funds, these volatility targeting funds are going to use leverage. They're going to borrow money in order to boost returns. And that's great, but I don't want to, underplay the value of leverage in a portfolio. It cuts both ways. When you're borrowing money and it goes well, that's great. That helps your returns. When it goes wrong, it really hurts because now you got to pay back not only the money that you lost, but also the money that you borrowed for your strategy. These models, they're far more quantitative in their construction. They start to get into statistical tools like ARCH models. That's an autoregressive conditional heteroscedasticity model. It's hard to say, but these are sophisticated tools. If you like to study stats, you're going to come across this kind of stuff. You like to study the CFA, you'll get a lot of exposure to these kinds of techniques. But it's through these kind of sophisticated statistical models that they realize, hey, wait a minute, we can target volatility and we can try to time it some because periods of volatility are followed by subsequent periods of volatility. There's proof in that in our regression analysis. And we know that there's an inverse relationship between returns and volatility, right? So when volatility is high, stocks tend to underperform. When volatility is low, stocks tend to perform very well. So if your quantitative research can help you forecast the volatility, then you can make bets on your portfolio and shift, tactical shifts to overexpose the asset classes that will benefit depending on the volatility. And then, even this stuff, with all its focus on risk, is not immune to the effects of a crisis or a market drop. So I really just want to throw those out there. There's lots of different, strategies. If you want to learn more, you can just Google that stuff. It's fascinating. It's great to get into. And I think that pretty much brings me up to an hour of pure talking. I apologize. It's a lot of information. But that's it. I am, ready to open it up for questions. I do have one last caveat before I answer questions, and that has to do with my own compliance department. So I can't give away any investment advice. Unfortunately, I'm not going to tell you what stocks you should buy or sell. I can't give away any of our proprietary information either. So no real investment advice, no proprietary information. They don't even want me to say what firm I work for, just so I didn't have to go through all these additional compliance hurdles that are associated with a public display. So I don't know how the questions are going to come, but I'll give it back to Alberto and let me know how we proceed. And thank you, everyone. I appreciate your time and surviving a long talk.
Thank you, Master. Now we are going to read some questions from the audience. Remember that all the questions are being sent by the Q&A button. And the first one is from Juan Jose Cabrera Lazzarini, and it says, Jan, great webinar. What is your opinion about ETFs and brokerage platforms such as Ameritrade?
ETFs. I am a big fan of ETFs. You start doing the research on active management performance, and it's not what you would hope, right? A lot of managers tend to underperform the benchmark, especially in the long run. And I think ETFs are great. They are very tax-efficient products. It's good for people the long-term horizon who are sensitive to fees, right? Because they're really cheap. I think ETFs you get 4 or 5 basis points from Vanguard. So if you want that kind of exposure, I think it's great. Long time horizon, very important. I think for young investors, I think it's a really smart idea to put your money to ETFs. I think as you start to retire and live off your portfolio, having an active manager there making decisions will probably serve you better during that period of your life. But that's up to you to decide. What very often we tend to do a combination of two, right? Markets are efficient, especially like large cap domestic. That's a very efficient area. It's hard to generate alpha there. But we know that other markets are not efficient. Emerging markets, it's easier to get an advantage, and certain managers can do very well and produce significantly higher returns than the benchmark. So ETF's great, long time horizon, don't want to spend the money because you're young, don't really care. Maybe as you get older and you need to live off your portfolio, have some active management in there, and then certainly active management in certain spaces just makes sense because they really do crush the benchmark. Markets are not efficient there. They can do carry trades and other strategies that really help them. As far as valuing brokerage services, I'm not going to speak ill of any of my competitors out there. They're all great. I think Ameritrade is very, very useful, very user-friendly, sophisticated in its platform. Most of them now charge, I think, like 0 commissions, right? Thanks to Robinhood and how popular that became. Every brokerage serve is placing trades for free. And they're all, good advice, good financial advisors there that you can work with if you want to. And I think Ameritrade is a great, great company. And if you're using that, kudos for you. I think that's a good choice.
Thank you so much. The next question is from Alex Rodriguez, and it says, hi, do you think right now would be a good time to trade as a swing trader due to the market volatility?
So what do you mean? Maybe you can clarify as a swing trader. Is he, I'm maybe not familiar with that term, or we use a different one in mind, just to make sure I have the right answer. Can he ask that, or you type in? Does he mean, get involved into options because of the volatility?
Yes, volatility.
So like I said, I'm maybe not as familiar with the term string trading. I'm trying to dig through my thesaurus of finance terms. But as far as getting to the market, I mean, the markets right now are very interesting, right? It's, you have all these sentiments going on. Is it bearish? Is it bullish? We've had this unbelievable V-shaped recovery, especially in the U.S. And people always ask, is it the time to get in? Once again, it goes back to what's your time horizon. If you're looking to, reap profits by the end of the year, you got to be careful, right? We have rebound quite a lot. It could say that we've gotten a little ahead in our skis. The markets are forward-looking, but they have decoupled a little bit from the economics. So it wouldn't be surprising to see some pullbacks. And it's turned out to be very sensitive to either positive or negative information, right? Every time there's an idea that a vaccine or a treatment is out there, the markets kind of shoot up, right? But then anytime there's an indication that there's more cases or the reopening's not going well, or there's a chance that this disease is going to come back and shut down the markets, it retracts pretty quickly too. So volatility is going to be there in the next several months, right? The VIX, how we measure volatility, is still at 30, which is unusually high relative to its history. I mean, a VIX of 30 means the market's expecting 3% moves daily. And it's come down quite a lot from the 80 that it was when everything, when stuff hit the fan, but that's a high VIX. So you should be cognizant of that you're going to have some volatility. So not a big deal if you're a long-term investor, because you got 20, 30 years, you can endure the volatility. I promise you, statistically speaking, you should have a higher market in 30 years than you do today. And if your question, like I said, I don't remember what the string stuff is, but if, you're talking about volatility as far as plain options markets, there's definitely high volatility is good for options market. That's where money is, made. So, as the volatility, shoots up, you can start, writing calls and puts if you'd like. And as it goes down and things tend to settle, maybe take the opposite end of that transaction. Go ahead and buy some. So I hope I answered your question, and I apologize for not knowing that term or having forgot it at some point.
Thank you so much. And now Gerardo wants to ask you a question personal. So go ahead, Gerardo, please.
Hello. What do you think about the dividend ETFs?
What do I think about dividend ETFs? It depends. I mean, once again, I think they're great. If you need income, that is a good source to get. It's a low cost way to receive income in your portfolio. Right now in the environment that we're in, I would say active management is going to serve you better than an ETF, right? Because the dividend ETFs, it's just going to follow a broad-based index. And some companies are going to suspend their dividends. They're not going to be able to pay them. They're not going to do poorly. So the ETF itself, relative to an active manager in this time period, would probably underperform, because the manager is going to look at the companies that are most likely to not suspend their dividend payments, to have, they can actually still afford them, and select them, constructively, with some of the biases that I said, primarily the quality in this current moment. If the economy reopening goes poorly, you're going to have solvency issues. These companies are going to go bankrupt, and the ETF in general will suffer from that. Whereas hopefully you picked a manager with the skill to read those balance sheets and avoid those companies. So in the short term, if you said, hey, I need income and I need a dividend producing income, I would lean towards active management. I would probably lean towards active management in just about every space right now. In general, for the long term, I think great idea to use dividend ETFs. Like, it's tax efficient, it's cheap, and they perform well over a long time period. It really depends on your horizon. So use that information as you will.
Thank you so much. The next question is from Andrea Rosales Castillo, and it says, could you recommend us books or courses to deep on the subject?
Yeah, I think if you're going to, it's a dry book. It is terrible, but it is a good foundation. It is called The Intelligent Investor by Benjamin Graham. Benjamin Graham is kind of considered the father of valuing companies. He wrote a really terrible book to read called Valuation. I don't recommend reading that. That's worse than any textbook you'll ever buy. The Intelligent Investor is better. Kind of simplifies it, but it starts to show you, hey, look, how do I develop my own internal stock selection strategy, right? Because there's so many ways to value stocks, and you kind of figure out like what ratios are important to me, and it's going to differ for every investor. Do you like PE ratios of a company? It's price to earnings. Do you like its price to book value? Do you like I'm a price to free cash flows guy. I believe everything should be correlated to free cash flows, but there's different ways for different industries and different stocks, and this book kind of gets into that. It'll give you some pretty good ideas from a foundation to like, okay, how am I formulating my own stock picking strategy? Is it consistent? Am I evaluating these companies the same way? There are other great books that are just fun, like A Random Walk Down Wall Street. It's an old one, but it's a classic. And then, like I said, if you want to get into this industry and you want, great 3 letters behind your name, like I said, they're not paying me, but I advocate the CFA. With the caveat, it's going to ruin your life for 3 years. It is like going back and getting a master's. It takes 3 levels, 3 years to complete. You're going to hate yourself, but you will learn a lot about investing in the process, and you will realize, more importantly, how much you don't know. And I think it's very advantageous professionally and rewarding individually as you really start to see how stock picking analysis is done. And there's so many good books. I could actually go on. You could read anything that Warren Buffett has touched. It's probably good, or John Templeton. Any one of these famous U.S. investors, they have their own books, and get some lessons from the greats. I would say, if you're going to play baseball or basketball, I would read a book by Michael Jordan. Right? It makes sense to study them. So. It never hurts. I'm not saying their strategies are still relevant today, but are you going to go wrong from reading how Warren Buffett became a billionaire? Probably not. All right. Even if you don't follow all of his methodologies, I would say Google the top famous 10 investors out there, either Ray Dalio or whatever, John Templeton, Franklin, and start looking into their books. They are packed with good advice.
Okay, thank you so much. The next question says, what would you recommend to start getting involved in the derivatives market regarding professional preparation?
Okay, so full disclosure, I don't trade derivatives. Like I really don't. In my firm, we have our own department that trades derivatives. I think before you get into that market, because a lot of options traders lose money, you should try to get very knowledgeable. There's great courses you can find online. I would start reading it, understanding the fundamentals of how this stuff works. I'm sure there's tons of courses available if you Google it, but I would get some sort of formal training in derivatives before you leap right in. Just because, people forget that, one contract's 100 shares, and it can start getting pretty costly if you're doing this wrong and you don't understand. It's a very technical aspect, you have to understand, the impact of the VIX and this market. You have to understand, delta, gamma, rho, theta, all the Greeks that you suffer through, but they all have a role in the derivatives, how the Black-Scholes pricing model even works. You want to have some foundation of that. You want to be able to hedge. You want to be able to conceptually say, okay, why do I want to get into a collar strategy? Right? Why am I long the call and a protected put? Why am I doing these collectively? What are the payoffs from it? And learning that on your own is difficult. It's not impossible if you have the free time figured out online, but I would advocate classes. I don't have any. I didn't take them. I just learned it through the CFA. And since I don't do it on a day-to-day basis, if my client needs a derivatives overlay, I work in conjunction with the guys who trade derivatives every day. So the incentive for me to be a specialist in derivatives is kind of small, other than my own entertainment. So I would just say, try to find a course, probably find an online tutorial, get you started. Maybe it's cheap, and read before you start diving into derivatives, or you're going to have, some costly lessons as you learn how this market works. A lot of fun though, a lot of fun.
Okay, thank you so much. The next question is a little bit long. Can you tell us about your daily routine and what is the hardest part? What is the first thing that an investment management specialist does when he wakes up? And what are some tips for the CFA?
Yeah, great. So when we wake up early. You got to be ready by 6:30 when the market opens. I live in the West Coast, so I live, in Las Vegas, Pacific Standard Time. Markets are wake up at 9. That's when the stock exchange opens. So we have to be ready by 6:30. And your days always start the same. You're going to need to read. There's so much information out there. So many things you got to process. Market moving information, right? So you're gonna have a lot of external research that's going to be provided to you by your investment firm. You got to read the Wall Street Journal. You're going to have tools like FactSet or Bloomberg Terminal or Capital IQ. They have research. You got to kind of look at what's happening in the market and then decide, how that's going to influence your trades. You have to read, the guidance from your firm, their over, under. So a lot of it in the first several hours of the day, it's going to be research related. And it's kind of continuous at night too. You can look at after hours trading, even though, in my firm, we don't really do it, but you want to get a sense of what's going to happen when the market's open. Interestingly enough, you don't do as much trading as you think. Not in my firm. We're not day traders, right? So we tend to have a buy and hold philosophy, kind of like Warren Buffett. So, once we build your portfolio and we figure out your asset allocation, we're going to start dollar cost averaging into the market. A lot of, investors prefer we go in kind of slowly to kind of reduces some of the risk and we get into it. So it's not like every day you're buying and selling and constantly watching what's going up and down because you're not trying to get that kind of, you're not fundamental, you're not technical analyst, you're a fundamental analyst, sorry. So there's not as much trading, you're gonna have to rebalance your portfolios, but it only takes a couple hours every day for like a week or two, you rebalance all your portfolios. And then a lot of our times you're not trading. What you're doing is you're reading, you're researching, and you're interacting with the clients, right? You're going to have a lot of client meetings. I work in the high net worth space. These are wealthy investors. A lot of them own their own companies and they're not used to giving up control of something to somebody else. So they're going to want to meet with you. They're going to want to talk with you. So when there's something happening in the market and a crash, your phone's going to ring or you better call them. So a lot of times you are preparing for client meetings. You're preparing portfolio reviews for them. You have to do prospecting as well. You have to go out and find new clients. You have to meet with centers of influence. And, in my field, you have to meet with estate planning attorneys because they're going to help, tax CPAs, meet with them, meet with transactional attorneys who just helped a merger or a selling of a company and get with them and try to find people. So I would say if I would split up my hours in a day, it'd be 2 or 3 hours just reading in the morning, relative. I would say the next hour is trading because it's just a smaller portion. And then the rest of the 4 or 5 hours of the day is either meeting with clients, preparing a meeting with clients, or actually going to get prospects, right? So that would be like kind of how I would say an average day would go. To prepare for the CFA, it is an exercise in discipline. You are not going to pass this test if you try to cram last minute. You have to want to have this if you go down this path. I would normally recommend 6 months of studying for each level. There is a lot of material. I really recommend you use some sort of study, company like Kaplan or Kaplan Schweizer, somebody who can synthesize the information because what comes from the institution, it's very dense and very large. You have to be willing to sit out like 2 or 3 hours almost every day for 6 months to slog through all the material. You want to make sure you do lots and lots of practice problems. So spend the first 3 or 4 months reading everything. You need to know a little bit of everything because you don't know what's on the test. And then spend the last 2 months just doing as many problems as possible because there's only so many ways to skin a cat. Eventually, there's a pattern to how they ask these questions, and you'll be able to do it because test day, a lot of questions, time constraint, a lot of pressure. and it's an international exam. So people all over the globe are taking it. You know, they're very smart people all over the world, and the exam doesn't have an absolute passing score, and they don't care if you can score a 70. It doesn't matter. It's graded on a curve. They are going to find a minimum passing score that kind of keeps them within a certain window of people who pass every year. So you're not beating the test. You are beating your peers. So keep that in your mind. If you don't want to study, there could be some kid in China or India who is studying right now, and your chances just got that much smaller because you're losing discipline. So that would be my advice. Be disciplined, don't cram, and get help. Pay for the Kaplan material, pay for Wiley or any other provider, I don't care who it is. Have them help you with their books, their online material. And just remember, you're not beating the test, you are beating your friends. So do that with your will.
Okay, thank you. And we're going with the next question. It says, do you know any tool we could use for free, like for example websites where we can evaluate stocks, bonds, and what aspects do you check to know if it is a good option, like ratios?
Okay, I think it's called FinBiz. I don't use it because I'm provided these tools through my work. I think FinBiz has a great stock screener, and they can, you can use their tools to help evaluate stocks. What's the other free websites? I don't know. I mean, it never hurts to sign up if it's free or a small trial for things like Seeking Alpha, The Motley Fool. These are advisors who might give you insights into good buys. Like I said, I'm sorry because I just don't have to look for that stuff. I have the good fortune of being provided a platform that has all this information, that has every ratio. Ratios that I like to look at, like I said, I don't care so much about a company's income statement. I know that top line sales growth is important to me, but the bottom line earnings, not so much. And that's because I know that people can manipulate this stuff. They can play games to shift earnings from one quarter to another quarter. They can change assumptions that they've used in these accounting procedures. They can write asset down, or they can not amortize something. They can do a lot of little games in accounting, and it's really hard unless you're like a CPA to really analyze it. So I try to not rely too heavily on that. So I prefer other metrics. I, generally speaking, will start off with the statement of cash flows because it is harder for them to lie there. And I'm looking at free cash flows, which is just cash flow from operations minus your CapEx spending. And I'm going to look at your cash flow from operations. I want to know, does your product or your strategy build consistent cash flows, not earnings? That's a bookkeeping. I don't care. You can have deferred revenue. That doesn't mean you've collected cash. I want to know the cash that you have because you can either pay that out as a dividend or you can reinvest it in the company in R&D. So I don't care about your earnings. It's bookkeeping. I care about the cash flow. So I'm going to look at that. Has it been growing? Has it been consistent? What are you doing with your working capital? I'm going to look at your accounts receivable, accounts payable. Are you trying to play games there to boost your cash flow from operations? Are you just really slow to pay your vendors and really quick to collect payment from people? Are you postponing stuff? So I will kind of take a look at working capital to make sure your cash flow from operations makes sense. I will bounce that off your top sales growth. Are they both kind of growing in line? Or is there no sales growth at the top, but cash flow from operations has been growing consistently? Probably means the company's doing something kind of funny with the books. So that's where I'm going to go to. I like those ratios. Price to free cash flow is one I always look at. Return on invested capital, I think is a good metric too. I want to know, that's your net operating profit after tax, kind of like your EBITDA adjusted for taxes over your different types of equity and debt funding. I want to know when we give you capital to invest, what's the return that we're getting and from what sources. So I think that's a good one as well. I always look at the interest rate coverage ratio. and your debt to equity from the balance sheet. Debt to equity, where do you fall out? Are you very leveraged or are you not? Interest rate coverage ratio, which is just your EBIT, your interest before earnings before interest and taxes divided by, sorry, I can't speak, divided by interest rate payment. I want to know how comfortable a company can make their payments on a relative basis, or are they going to default on anything? So I will definitely take a look at that. Those are some of the ratios that stand out. Price to earnings is sure, it's a big one in the market. I'm not that impressed. Like I said, I think earnings are manipulated relative to what, maybe the PEG ratio. I prefer to look at price to earnings compared to the growth of the company starts to give me a better picture. And as always, when I'm evaluating a stock, I want to make sure that there's a narrative that I have conviction in. There's a story I can say about the company. I understand what they're doing. I understand their product differentiation. I understand that they give a superior product. They can capture market share, and I want to make sure that the industry that they're in, I think, is going to grow, right? That industry itself is going to expand. And then, any ratio by itself is kind of useless. What does a PE of 20 mean? I don't know. I don't care. But what it means to me, if its competitor, its industry has a PE of 12, then this company is expensive. It has a PE of 20. So make sure as you figure out, okay, I got the ratios to like. I know the company's price to free cash flow. I know whatever, all these different ratios. Let's start comparing them to other companies. What is its peer group? What is its competitors doing? And what is the industry doing? Now, is it a good company? Is it a bad company? And that's, how you should kind of approach that process, in my opinion. Great question.
Okay, thank you so much. I think that was the last question because of the time. And we want to thank you, Master Jan. It was a pleasure to hear you in this afternoon, learn about this topic from an expert like you. It was so gratifying for all the audience. And if you let me share my screen. Okay. The Mexican Institute of Financial Executives, in its undergraduate branch from the Marista University of Mérida and the Monterrey Institute of Technology Campus Querétaro, delivered this acknowledgement to MBA Jan von Herburt-Hewell for giving the conference model portfolio asset allocation that took place on May 21st, 2020 by Zoom platform. Thank you so much, Jan.
Thank you. It's been a pleasure. That is too kind. Ricardo, Miguel, Alberto, Liana, thank you so much. I really appreciate your time. Everyone who watched, I hope you learned something. I had an absolute pleasure, and I just enjoyed this thoroughly. So thank you so much, way too much. And I hope to see some of you again sometime. I don't know how, but if you ever need anything, please don't hesitate to reach out. I hope we interact again.
Jan, thank you very much for accepting the invitation. It was a pleasure to have you here.
Thank you. Thank you. Thank you very much. All right, everyone. Have a wonderful evening. Stay safe. Stay healthy. I'm going to go ahead, sign off, and have some dinner. So thank you very much, and goodbye, everyone.
Thank you.
Goodbye, Jan. Thank you.
Thank you very much.